At school, when I was in the sixth form, I so vividly remember being told by my school teachers not to worry about paying off my student loans. The teachers would say stuff like, you're basically never going to pay off how much you borrowed, and so there's no point paying down your student loan early. And what did 18-year-old me do? I just decided to listen along to them and go with what they were saying. And that's because after 14 years of schooling at that point, I'd pretty much got it instilled into my head that my teachers knew what they were talking about and weren't likely to be wrong. And to be honest, I really didn't think too much about the subject of student loans until my second year of university, when the maths finally started mathsing. I quickly realised that even in the space of just 1 year, I'd pretty much gone and shot myself in the foot by taking out a student loan. In today's video, I'm going to walk you through how exactly student loans work and why it might make sense for you to pay them down early. And so without further ado, let's get straight into the video. So let me start off by giving a quick explanation of how student loans in the UK, and more specifically England and I believe Wales, work. Now, there are two types of student loans. The first is a tuition fee loan and the second is a maintenance loan. So the tuition fee loan, as the name suggests, covers the annual cost of tuition for university, which in most cases is £9,250 a year. You'll basically never see this money, it gets directly sent across to the university which you attend. The maintenance loan is meant to cover things like food, accommodation, and any other expenses that you might incur as a university student. The maintenance loan is means tested, which means that the size of the loan depends on your parent or carer's financial circumstances. The idea is that if your parents earn more money, that they will contribute or chip in more to your cost of living whilst at university, and therefore the size of the maintenance loan that you get from the government will be lower. Now, with the maintenance loan, the money gets directly sent into your bank account at the start of each term. Interest is the big kicker. You are charged interest on your student loan from the very first day that you take it out. Now, before I go any further with this video, it's worth noting that besides the difference between maintenance loan and tuition fee loan, there are also differences in what are called plans. Now, plans basically dictate how much interest you pay on your loan and also the terms and conditions of repaying your loan. Now, the plan that you're on depends on when you started university. So if you started university before 2023 and after 2011, so that is from 2012, I believe, to 2022, then you are on a Plan 2 loan. Whereas if you started university from 2023 or afterwards, you'll be on a Plan 5 loan. And so it's important to keep that distinction in mind. Going back to the topic of interest rates, whilst you're studying, the interest rate that is applied to the amount of money that you've taken out is variable and linked to inflation. Specifically, it's linked to RPI plus 3% if you're on a Plan 2 loan, or just RPI if you're on a Plan 5 loan. Right now, with inflation so high, there is a cap on the interest rate, i.e. a maximum interest rate applicable, which is 7.5%. If you're on a Plan 2 loan, the interest rate you pay after you graduate depends on how much money you're making. So if you are a high earner earning more than £49,000, you still pay the full RPI plus 3%, whereas if you're earning below £27,000, your interest rate is just RPI. And if your salary is between 27 and 49k, you're kind of on a sliding scale paying somewhere between RPI and RPI plus 3%. Again, there is a cap of 7.5%, so in a world where RPI were theoretically 8%, then regardless of your salary, if you're on a Plan 2 loan, then your accrued interest would still be capped at 7.5%. If you're on a Plan 5 loan, then the mechanics are a lot easier because salary doesn't matter. Irrespective of how much you're making, everyone's student loan will be set at RPI, or that cap of 7.5%, as I mentioned before. Now, the interesting thing with UK student loan interest is that the interest rate that you incur on that loan is different to the interest that you actually pay. And I know that sounds pretty weird, and it is, and that's because it's a different system to pretty much any other loan that you'll probably come across. So, to explain what this means, let's say that on day one of university, you've taken out £15,000 worth of maintenance and tuition fee loans, and the interest rate for that year is 7.5%. That means that the interest rate charged for that year is 7.5% of £15,000, which is £1,125. But this doesn't actually mean that you have to pay £1,125 that year. In reality, what happens is that £1,125 gets added to your initial student loan balance. So your student loan balance increases from £15,000 to £16,125. So at the start of year 2 of your degree, your student loan balance is now £16,125. Now let's imagine that you've now watched this video and you decide to not take out any further student loans. Let's also say that the interest rate for this year is still 7.5%. So that means that your interest charge for year 2 would be 7.5% of £16,125, which is £1,209. As before, you wouldn't actually have to pay that £1,209, it gets added to your previous loan balance. So now your loan balance has increased from £16,125 to £17,334, and so on and so forth. This process carries on. So you might be wondering, if I don't actually have to pay this amount, then what is it that I actually do have to pay? The way it works is that from the April after you graduate, you pay 9% of whatever you earn above a certain threshold level of income. And that threshold income depends on whether you're on a Plan 2 or a Plan 5 loan. If you're on a Plan 2 loan, that threshold is £27,295, whereas if you're on a Plan 5 loan, that threshold is just £25,000. So let's say you earn £30,000 a year in the year after you graduate. That means if you're on a Plan 2 loan, you have to pay 9% of £2,705, where £2,705 is the difference between £27,295 and £30,000. 9% of £2,705 works out to £243 a year, and you'll make that over 12 monthly payments. If you're on a Plan 5 loan, then you'd be paying 9% of £5,000, where £5,000 is the difference between £25,000 and £30,000. 9% of £5,000 is £450 a year, and as before, you'd make that in 12 monthly instalments. Do you see that because of these mechanics, the amount of interest that you incur on your loan is different to the amount of interest you actually pay every single year? It could be the case that your student loan balance is incurring thousands of pounds of interest every single year, but you might still only pay a couple of £100 anyway. Finally, it's worth noting that after a certain period of time, your student loan gets scrapped, regardless of how much of it you've paid down. If you're on a Plan 2 loan, your student loan gets scrapped after 30 years, whereas if you're on a Plan 5 loan, it's 40 years. And so it's because of these reasons that teachers often say that you don't need to worry about paying off your student loan early. And that's true if you don't expect yourself to be a high earner coming out of university and you don't expect your earnings to grow all that much. If you're on a Plan 2 loan earning £30,000 a year and your salary doesn't increase, then you'll continue to only be paying £243 a year for the next 30 years, which means that after those 30 years, you'll only have paid £7,000, which is going to be a lot less than how much money you initially borrowed to study your degree. Similarly, if you're on a Plan 5 loan, again earning £30,000 with no salary increases, then you'll be paying £450 a year for the next 40 years, which is £18,000 over that period of time. And again, that's going to be less than how much you borrowed to actually study your degree in the first place. However, the idea of not paying off your student loans early becomes problematic when you are a high earner, and especially if you are a high earner coming straight out of university. And that's more than likely going to be the case if you're doing something like consulting or working in finance. Just to prove my point, let's do the maths for someone who's in that situation. Let's say that you're on a Plan 2 loan and after university you're going to be entering a consulting job earning £50,000 a year. After 3 years of studying at university, it's more than likely that your student loan balance is going to be around £50,000 a year. After all, you did 3 years of tuition fees at 9.25k. Let's imagine that your maintenance loan was around 5k a year, and you probably got a bunch of accrued interest in that 3-year period as well. So 50k sounds reasonable. On a 50k loan balance, let's say that the interest rate, as before, is 7.5%. That means that your interest charge for that year is going to be £3,750. In the same year, you'll be making student loan repayments of 9% of the difference between 27 and 50k. I know it's 27,295, but for simplicity, let's say it's 27. So imagine you've just paid £2,000 worth of student loan repayments this year, yet on net terms, your student loan balance has actually increased by £1,700. And yet to this, some of you might say that 7.5% isn't a realistic long-term assumption for RPI plus 3%, but let's run a sensitivity and just say that that number is 5% instead. Even then, your student loan balance will have increased by £2,500 and you'll have still be making those £2,000 worth of repayments. So again, in net terms, your student loan balance has increased by £500. The overall summary is that if you are a high earner straight out of university, you are more than likely going to pay off your entire student loan balance, so the amount of money you borrowed plus all that accrued interest within the next 5 to 10 years. I created a quick and dirty Excel spreadsheet to run the analysis for myself, and I found that on a £50,000 student loan balance after university, depending on the interest rate and earnings assumptions, I would be paying off £80,000 to £100,000 within the next 5 to 10 years. So I guess the point I'm trying to make is, if you are a high earner or suspect that you will be coming out of university, then don't just take what your teachers told you as gospel. Go away and run the calculations yourself and see if it makes sense for you to pay down your student loan early. If you want a copy of the Excel I used, I'll link it down in the description below, completely for free for you to download. And so with that brings me to the end of today's video. I hope you did enjoy it and find it useful. If you did, please smash the like button, subscribe to the channel, and share this video with your friends if you think they might also benefit from it. Let me know in the comment section down below what else you'd like to see from me. And with that, guys, I'll see you next time. Thanks again.